Welcome! In this explainer, we're going to break down the formal procedures for preparing financial reports and documenting recovery actions, using the provided learning guide as our framework.
So here's what we'll be covering. We're going to start with a review of accounts and debt. Then we'll move into developing key account reports. After that, we'll cover planning recovery actions, and we'll finish up with how to properly store and manage your records.
Okay, let's dive right into Section 1. This is all about establishing the foundational concepts of accounts receivable and building a framework for debt recovery. So, what are we actually talking about when we say accounts receivable? Well, it's pretty straightforward. It's the money that's owed to your company from customers. The guide really emphasizes that keeping a detailed ledger is absolutely crucial to track exactly who owes you money and how much. Now, the guide breaks debt down into 4 main types, and it's really important to get your head around these. You've got secured debt, which is backed by an asset like a mortgage. Unsecured debt isn't tied to an asset. Think credit cards. Then there's revolving debt, like a line of credit you can use again and again. And finally, installment debt, which is paid back in fixed amounts, like a car loan. Okay, so to make this a bit more concrete, let's look at how these debt types show up in a real business setting. A loan for some new equipment, that's your secured debt. Those credit card bills for office supplies are unsecured debt. That business line of credit from the bank is a classic example of revolving debt. And the loan for a company delivery van is a type of installment debt. You know, before you can fix a problem, you've got to understand what caused it in the first place. And when it comes to debt, the guide points to a few common culprits. It could be simple late payments, deeper financial troubles for the client, a dispute over the service they received, or sometimes just a simple mistake or oversight. So what do you do about it? Well, the guide lays out a really clear 5-step plan for debt recovery. You start by identifying which clients are in default. Then you make contact. It's critical that you follow your organization's policies. From there, you review any past actions. And finally, you develop a formal recovery plan. All right, let's move on. Section 2 is all about developing those key account reports, the kind you need for internal reviews and proper supervision. So why bother with these account reports? Well, their main job is to give you a clear, fact-based snapshot of the company's financial health. This summary is absolutely essential for management to make smart decisions and to communicate effectively with stakeholders. And according to the guide, for a report to be truly comprehensive, it absolutely has to include these 7 key pieces of information: revenue, expenses, assets, liabilities, equity, cash flow, and of course, profit and loss. Of course, a report is only as good as the data that goes into it. So where do you get that data? The guide points to these primary sources: bank statements, sales and purchase invoices, and your payroll records. Now, this is a really important distinction the guide makes. There are 2 separate but equally critical jobs here. First, there's structuring the report, making sure it has a clear title, headings, and is easy to read. And then there's the second job, verifying the data. That means checking for errors, comparing it against original documents, and making sure everything is consistent. Okay, moving into Section 3. This is where we get into the nitty-gritty of actually planning and documenting your recovery actions within that reporting framework. But before we jump into the methods, let's take a step back and ask, what's the whole point of these recovery actions anyway? The guide is really clear on this. There are 4 main objectives you're trying to achieve here. First, to maintain a healthy cash flow. Second, to reduce bad debts. Third, to protect your client relationships where you can. And finally, to make sure you're legally compliant. Okay, so you know why you're doing it, but where do you actually start? What's that very first step you need to take? Well, the guide says the first thing you need to do is a thorough review of your debtor ledger. This is where you'll spot the accounts that are either already in default or are at high risk of heading that way. Now, you've got a whole toolkit of methods you can use. The idea is to start soft and escalate if you need to. You might begin with reminder letters or phone calls, perhaps move to setting up a payment plan. If those don't work, you might engage a debt collection agency. And only as a final resort, consider legal action. All right, we're on to our final section, Section 4. This is all about the crucial but often overlooked topic of storing and managing all your reports and records properly. Let's start with a really important number. Here in Australia, the Australian Taxation Office, or the ATO, has a strict rule. You have to keep most of your financial records for a minimum of 5 years. When it comes to how you store those records, you basically have 2 main choices: physical or digital.
Physical storage, think filing cabinets, is simple, but it eats up a lot of space. Digital storage, on the other hand, is much more space efficient and accessible. You'll need to weigh the pros and cons for your organization. Look, staying compliant isn't a one-time thing. It's an ongoing process. Adhering to your own policies and the rules set by bodies like the ATO and ASIC is absolutely non-negotiable. That means maintaining accurate records, running regular audits, keeping up with changes in the law, and knowing when to call in the professionals for advice. And that wraps up our briefing, but we want to leave you with one final question to think about for your own organization. How can you make sure your record storage system isn't just effective today, but stays compliant and robust for years to come?